Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say or do should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of December 15th, 2024. And in this week's episode, we are going to dial back to some of the basics. And when I talk about the basics, we are going to touch on selling options safely. So a lot of newcomers are very intimidated by what they've read about options and how they can lose 100% of their money. They're extremely risky vehicles. And all of this, well, it can be true. There is an aspect of this that if you understand the mechanics and you understand what you're dealing with, you can actually trade options, both buying and selling, fully defining your maximum loss and the type of risk that you want to take on as a trader. And that's what we're really going to dive into this week's episode. We are going to look at what's known as the option vertical. And the option vertical is a way that you can sell options and capitalize on my favorite strategy of theta decay and volatility decay, while doing so in a manner that will define your maximum risk that you are taking on. And you can tailor that risk to your comfort level. This is very different than selling some of the options naked, where you can have unlimited risk, and that can be very scary as a trader. So in this week's episode, we're really going to pull that back and look at the underlying mechanics to explain and demystify selling options. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Finally, this is available in an audio-only format wherever you get your podcasts. So find us there, like us, subscribe, and if you can't find it, let us know and we will get it there. But let's hop to the content this week. And the content that I want to talk about this week was kind of inspired by a conversation that we actually had in our Discord this past week, where one of the traders was kind of inquiring a little bit about, getting tempted to sell some options, but is a little concerned about some of the mechanics and didn't really want to lose a lot of money and wasn't really sure because there's a lot of information out there that talks about how dangerous options trading can be and how you can lose a lot of your options. They just really weren't comfortable kind of selling the option yet. And so I thought, you know what, let me take a little bit of time this week and let's talk through some of the mechanics of option selling in a way that you can do it by defining your risk. And that's important because a lot of times when you sell options, you really have unlimited risk, which is uncomfortable for a lot of traders who like to define their risk with stop losses or price movement or things like that. And when you get into selling options, a lot of times some of that stuff doesn't apply. Sure, you can kind of lace it in here or there, but generally speaking, selling options opens you up to very, very high and unlimited potential. Now, albeit relatively low probability, but the potential is there for very significant risk. And then I think that turns a lot of traders off into even starting to talk or look into options simply because of that rumor. And so I want to try to dispel some of that because, as we always talk about on this show, education really is the best weapon against a lot of this stuff, is understanding the underlying mechanics, understanding what's happening underneath the hood. And that's really going to help you make a better decision about what is or is not appropriate for your trading tolerances and your risk profile. Now, before we hop into some of the mechanics of a lot of this, I want to just dial back to the absolute very basics and the building blocks. Because when we're dealing with what's known as an option vertical or an option spread, you'll hear them talked about both ways. There are basically two components or two legs to the trade. And there is going to be what's known as the short leg and the long leg. So just like trading in regular underlyings, regular stocks, when you are short something, you are selling it. And when you are long something, you are buying it. And so I'm going to pull up this little graphic, and I want you guys to take this in and think about this. So what I've done is I've put a U column, that is the trader, that is you, that is me, that is the person that is basically trying to enter into this contract or enter into this trade. And then the other party is the party that is we are either selling something to or buying something from. And the important thing to note on this graphic is the little contract icon, and that is who holds the option contract. So on the short leg, you are selling the option contract to the other party. On the long leg, you are buying the option contract from the other party. And this is where the colors can get kind of confusing, and sometimes people get backwards when they deal with options. But when you are selling the option, you are basically collecting money. So that is basically your profit leg. That is the leg that is going to generate you revenue. That is the leg that is going to create your profit. When you are buying the protection leg on a vertical, when you are selling a vertical like this, you are paying money for protection. So this is going to cost you money. This is going to put a dent in what you collect as a premium, but it is also your insurance policy against big, massive movements of the underlying. So just as a reminder, the person that holds the option contract is the person that has the right, but not the obligation to exercise the option. So, for example, if I sold someone else a contract of an option for a $100 strike on a particular share expiring next month, anytime before next month, that other party can say, you know what, I want to turn in my coupon and I want you to sell me 100 shares at $100 of whatever it is. Now, they will typically only do that if that price trades above $100 because now they can buy it for less than the market value. And buying is the exact same thing, except the parties are reversed. So you are buying the potential and the opportunity to cover your shares, but you don't necessarily need to. And we'll talk a little bit more about what that actually means. Just remember, he who holds the option contract is the one that holds the right and not the obligation to exercise the option. Now, you can do an option vertical either on the call side or the put side. So remember, the call side is the side trading above where the current stock price is, and the put side is basically the area below where the current stock price is. And the example I want to look at here today is basically the call side, because the call side of trading options or selling options can be the more dangerous side when it comes to risk. So a lot of times when you want to define your risk, when you want to have protection, you're going to do it on the call side. And the reason for that is going to be shown in this graphic here on this page. And so what I have here is basically two ways to sell premium. You have the way of selling it naked, which means no protection, and then you have a way to sell it with what is a vertical, which is what this episode is about. And what I mean by that is if the particular price is trading where this very finely dotted line is, this is your strike price. And then once you get above your strike price, it is going to start losing money. So this $1,000 is the premium that you collect from wherever the strike is, somewhere below this strike price. And then as you get above that, you start eating up your premium that you've collected to pay for this option, or in case the other party wants to turn it in, right? You're going to be obligated to sell them this stock at $100. So if the stock goes to $110 like this shows, you're going to have to spend $1,000 extra to buy that stock, because you're going to sell it to them for $100, but the stock is trading at 110. So you have to go to the open market. If you don't have these shares, buy them at 110. That's $10 over your strike price. 100 shares, $1,000. So that's why that is zero. You make no profit in that scenario. And then this is where your risk really goes to infinity. Because there is no limit to how high a stock price can go, there is no limit to what you will be obligated to buy that stock from the open market. So if that stock were to go up to $150, you need to go to the open market, pay $150 for that stock, only to turn around and sell it to the guy that you sold the option to for $100. So in that case, you would lose $5,000, but you collected $1,000, so your net would be a $4,000 loss. And that is why on the call side, things are so dangerous or can be so dangerous because there is no limit to the upside of an option. There is a lot of times on the downside, an equal amount of kind of high loss potential, but zero is as low as a stock can go. So, well, it is relatively unlimited because you can go to zero. Zero is as low as you can go. Where on the top side, you could go 500%, 600%, 1500%, right? There's no limit to how high that stock price can go. And that's where kind of defining the risk comes in, is because what happens is when you define your risk, you sell the short leg, which is you'll do that closer to the money, and you will buy a protection further out. And what that does is that caps your loss. That says, okay, I cannot lose more than this. Because in the same example, if you had purchased a share price or a stock price protection at, in this example, I guess it's not the same scale, but at $320, you are able, because you have that contract, to purchase for $320 no matter what the price is trading. So if it goes to $600, you simply turn in your contract to somebody else, buy the shares at $320, but you still have to fulfill your obligation at $310 in this example. And so that $1,000 delta is basically what you will be out. But you have capped your maximum loss. You have defined your risk. And that is really the magic of adding this protection leg or this vertical, is the maximum loss that you can encounter is the difference between the premium you collect and the width of your strike. So in this example right here, you have a 310 short strike and a 320 long strike. So the difference of that is $10. So multiply that by 100 because in options, everything is in shares of 100. So your maximum risk potential is $1,000 minus what you collected in premium. So here you collected $300 in premium. So your maximum loss is going to be $700. You cannot, under any circumstances, lose more than $700. And so that is how you calculate the risk of a vertical. What's the maximum loss you can have? And I'll say it again. You take the width of the strike, multiply it by 100, and then subtract out the premium that you collected. So if you are $5 wide, that is a $500 risk minus whatever premium you collect. So you might say, well, why would I ever trade something without a protection leg? And I've kind of highlighted some of the different characteristics here below. Is when you trade naked, you have a higher profit number because you are not giving up some of that premium to buy the other protection leg. So remember, when you're buying that other protection leg, you have to pay money for that. So if you sold at, let's say, $400, the short strike, you might have to pay $100 to buy this long leg. So you use some of that premium that you collected from your short strike to pay for your insurance policy. So if you don't buy an insurance policy, you inherently will have a higher profit. Now, the drawback to that higher profit is you have a higher risk. It means a higher risk of you could lose more money because you're not defining that top end risk. And that's some of the trade-off that you have to take into account. The other thing, and I won't go into that in this particular episode, but you'll hear me talk about on other episodes and things like that, managing your losers by rolling forward the option, pushing out in time. That really doesn't work for option verticals. There's a few different reasons why, but for simplicity, just assume that a vertical is a one play and done. The ability to roll a vertical for a credit is a relatively rare circumstance. And so that's a difference because when you trade options naked, you pretty much almost always can roll for a credit. Now, you're going to suck up a good bit of buying power and other things, but you will not be able to really manage a vertical if that vertical becomes challenged. So that is a trade-off. You're going to define your risk so you will know what your maximum loss is. But if this trade goes against you, you pretty much are probably going to end up with a losing trade as there is not much of an ability to manage it. Now, before we get into a few examples and kind of talking through some of the mechanics of this in a real live trading window, I want to just add one more piece of data that is very important, in my opinion, of when you're dealing with the vertical, and that is what's known as volatility skew. A volatility skew basically has to do with the pricing of the options. And this will make sense a little bit more when I start pulling up examples. But there's three buckets that volatility skew can fall into. You have your call skew, no skew, and put skew. And what that really just means is the price of the option and what is the distribution of how expensive or inexpensive that option is relative to the at the money price. So if you take a look at the screen here, and you've got this center line, this is the at the money price. Every time you have an option of at the money, it will have the most extrinsic value. I'm not going to get into extrinsic versus intrinsic, but extrinsic value is effectively the premium that you're going to pay on the option that is related to time and volatility. And the most expensive or the highest extrinsic value is always at the money. Whatever the current stock is trading at, the price point that is closest to that, the strike that's closest to that price point is going to be the most expensive extrinsic value. And call skew, you'll see, is when that extrinsic value continues to remain high as you get higher in price, right? It falls off more slowly. So if you look at this distribution, there is more extrinsic value above the current price than below. When you go below, it starts to fall off a bit quicker. That means that the general market sees risk to the upside. And what that means is there is more traders betting that the stock is going higher than it currently is now when you have heavy call skew. That means there's a lot of traders out there with bullish trades pushing the stock higher. And the options are looking as an insurance policy. So you will see a lot of call skew on very memey stocks. So GameStop, AMC, all the things in Wall Street bets and all of that will typically have very heavy call skew. The reason this is important is the vertical is a little bit harder to profit from when you have heavy call skew. And I'll show you why. It's harder to profit from on the call side. So if you have heavy call skew, it's a little bit easier to profit from the put side of the trade. Whatever trade is falling off faster. And I'll show you that in a minute. When you don't have any skew, it means you have an distance distribution across both the put and the call side of the option. So doesn't matter, 5% up is the same price as 5% down. Whereas on call skew, maybe a 5% gain might have a higher price point than a 5% loss when it comes to extrinsic value. Put skew is the exact thing as call skew, except in the other direction. So if you have a stock that is very bearish, it's really falling a lot, you will have put skew. Put skew is probably the most common thing that you will find when you deal with volatility skew is options tend to have a put skew to them to some degree. Sometimes it's more pronounced than others, but generally people trade options as insurance policies for the downside risk. So a lot of options will have what's known as put skew. I'm going to pull up a hypothetical example here in just a second, but if you think about what I just told you here, if you have a heavy call skew, right, and you want to sell an option leg out here, out of the money, above the current strike, and then you want to buy a protection leg, that is why this is a little bit more difficult, because your price on that protection leg isn't going to fall very fast. So you're going to come out further to buy your strike, but you're going to find that you're still paying a lot of extrinsic value due to the call skew. So it makes it harder to get a cheaper protection leg. So yeah, you're going to sell good premium for the leg you're selling, but because the value of that option doesn't fall off fast as you get higher in your strike, you're going to still have to pay a good bit of extrinsic value for that protection leg. On the flip side, if you had heavy put skew and you were trying to sell on the call side, you might play closer to at the money, but your protection leg is going to be cheaper because the price of these options on the call side is going to fall off faster. So your protection leg is going to cost you less money. And if it costs you less money, that means you get to keep more of that initial premium. So it's going to eat into your profits less. And that's really where skew is so important on the vertical. It doesn't matter as much when you trade naked because you're not buying that protection side. But when you're buying the protection side, you want to get a good price on that protection leg. Now, one of the ratios that I look at when I am looking at a vertical is I want to be able to collect about 1/3 of the cost of the width of the strikes. And what that means is if my width of my strikes is $5, I want to collect about 1/3 of $500, so $165. And that's really where I kind of look at my trades when I trade verticals to see if that's a vertical that I want to sell. Because a lot of times the premium that you're going to collect will be less than 1/3 of the width of the strikes. And for me, that is not a good risk trade-off, right? So if I'm risking the maximum width of $500, but I'm maybe only collecting $100, that means I am potentially putting on the risk table $400 to collect 100. And you might think, oh my gosh, why would you ever do that? Or even 1/3, why would you ever collect $165 to risk, losing 300 and some, or the difference of that 500? And I'll talk about that because that difference is the probability of success. When you sell these options, the probability of winning is much, 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 much higher than a share price trade. And so when you trade raw shares, you'll hear things about risking one or risking three, risking one to make three, risking one to make four, right? You're talking about multiples. And when you're selling these options, you're kind of doing the reverse of it, right? You're risking three to make one. And that sometimes is hard for people to wrap their brain around. And the reason you're doing that is because your probability of success is tremendously higher. And I'll talk about that in my hypothetical example, and then I'll show you in the live trading platform what I mean by that. So let's go ahead and take a look at the hypothetical example that I've put together. And so in this hypothetical example, we have some type of stock, and it's trading at $100 a share. And you have a thesis that you are not mega bullish, means you don't think this stock is going to the moon, might hang out at $100, might go a little bit over $100, and might fall away from $100 significantly, a little bit, don't care. All you know is you don't think it has enough rocket fuel to blast off. And so knowing that thesis, let's take a look at how we trade some of these. Now, I didn't clutter this up with all different option strikes or things like that. I just kind of arbitrarily made up some numbers. So we're going to look at selling about a 20 delta option. So we go back to the very beginning. We're talking about the short leg, the profit leg, the leg that we're going to collect money. We are going to sell the 20 delta option. Now, I will typically target about 35 to 45 days out. So in this example, we're going to look at an expiration that's 45 days out from today. And in my hypothetical option chain, you're going to see that a $105 strike is about the 20 delta, and it is trading at $2.55. So that is all out of the money. So that's all extrinsic value, and it's $255. Now, the $110 strike is going to be our protection leg. So there's really not a good definition of where do you put the protection leg. That is the risk flavor that you get to add. And I'll show you how you can experiment with that and look at a P&L chart in your particular brokerage to decide what you're comfortable with. So in this, I was basically targeting a $5 wide strike. So 105 is my short. I wanted to go out $5 and buy my protection. And that keeps me at a $500 risk trade. I didn't take into account the premium that I'm collected, but that width is $5. So that happens to be about a 10 delta in my hypothetical. So, and that option would be trading at 90 cents. So what that means is I'm going to sell my short leg for $2.55, collecting $255. but then I'm buying my protection at 90 cents. So I'm netting a credit of about $165 because I have to pay $90 for my protection. I collect $255. That puts me at about $165 net credit received. That is ironically exactly my 33% of that $5 width. So this is the value that I told you I target when I sell verticals, is I want to be able to collect about a third of the width of the strikes. So what happens here? If the stock moves 5% lower with my naked option, it means I didn't buy the protection leg. So this column here of naked means what happens if you don't have protection. I would collect $255. In my vertical, this is when I did buy protection. How much money do I make? Well, I collect $165. What is the probability that this is the outcome? It's about 80%. And the probability you derive from the delta numbers. And so basically what it means is if 105 is a 20 delta, that means there is a 20% chance that the stock will trade above 105. And there is an 80% chance that the stock will trade below 105. And so that's really where this probability is determined. It is tied to the delta. So a 20 delta means there's a 20% chance that the stock will be at or above that strike at expiration. So what happens if the stock goes down 20%? Well, naked, I make $255. Vertical, I make $165. Again, 80% probability that these are the outcomes that I would get. What if the stock goes up 5%? So if it goes up 5%, it's now trading at $105. And here, the naked, I would pick up $255. The vertical, I would lose $165. Again, about an 80% chance that that is where we will end up. So now we get into a little bit more interesting. So remember, the thesis was we would not get rocket fuel and take off. So the last two cases are, okay, what happens if I was wrong and we get the rocket fuel? So if we get the rocket fuel and we go up 20%, this means the stock is now trading at $120. So my naked strategy, I would be underwater $745. In my vertical, I would be underwater $335. So see, we have now passed that protection leg. So the protection leg is 110. So anything over 110 on the vertical strategy, you are 100% capped, 100% isolated. You will not lose any more money. So this is probably about a 5% chance that this might be the outcome. And what if this thing actually goes 30% move? It's possible, right? I mean, wasn't that many earnings ago that NVIDIA, I think, ran 33% after earnings, which is a mega cap. And if you jump 30%, now my naked strategy will be underwater $1,745. Because remember, there's no protection. Stocks can go to infinity. I can continue to lose money, lose money, lose money. What about that one where we bought the protection leg? $335 loss. You're capped. Now, you're probably dealing with like a 99 delta or a 1 delta, sorry. When you're at a 30% move, you're multiple standard deviations above. So the probability of hitting a 30% move is less than 1%. And this is where that risk tolerance and that risk appetite comes in. Because some traders might say, I can't take that risk that there was a less than 1% chance that I'm going to be eating, $1,800 of loss. So if that is your risk appetite, then yeah, this vertical makes a lot of sense. Other traders might say, you know what, I'm okay with that risk of an $1,800 loss if it means I stand to gain or pick up more profit. So you are accepting that risk of this large loss on a big rocket fuel move to get a higher potential today. And that's really all that this vertical comes down to, is it comes down to adding protection to your trade to a level of which your risk tolerance, you find comfort in that. All right, so let's take some of this information and let's jump into a trading platform and take a look at this. So I'm going to take you over to the trading platform that I use occasionally. I actually use a couple different trading platforms, but the one that I want to take you to is Thinkorswim. This is a trading platform that is tied with Charles Schwab. And what I want to pull up here is GameStop. So I pulled up the GameStop stock, last trading at $27.99. And what we have in here is the option premium. So out of the money premium of all the strikes of extrinsic value. And this is that skew graph that I was talking about. So each one of these lines is a different expiration. Basically, the lines that are lower here are going to be expirations that are sooner, so they have less time premium. And then the farther up the line goes, the further out in time that is. And so this is just all the strikes on one. You can kind of narrow this down if we just wanted to look at, let's say, January strike. Okay, so this is the strike that's going to expire on the 17th of January in 2025. And this is what I'm talking about, skew. So this peak here is basically at the money strike. Where is the stock trading? And you can see exactly what I'm talking about here. You've got the put side, which falls off very, very, very sharp. And you have the call side, which falls off much more slowly. This is an example of call skew. And where that is going to play into it is when we pull up the option chain to look for trades, you're going to see you're going to get a higher, keeping a higher percentage of your premium on the put side versus trying to enter a vertical on the call side. So I'm going to go ahead and we're going to look at the option chain for this January expiration. And I'm going to go ahead and put two different verticals on, and we're going to take a look at the profit and loss and how you can kind of mess around and see what it looks like. So if I come up here to the option chain, this is going to show me the different option strikes. And I'm going to go ahead. This is the 17th of January. It's got 110% volatility. And we want to try to put, we say, you know what, it's GameStop, it's Mimi. I think these guys are way overblown and the price is going to come off, but we're not going to get rocket fuel. And so I typically like to look at these option chain charts with delta in mind so that I can kind of scroll down here in this column labeled delta, and I can look for, where is about a 20 delta. Now, when I do verticals, I typically don't really start at the 20 delta. I'll come up as a little bit more aggressive to like a 30 or a 35 delta because I'm going to collect more premium on that short leg. But let's just go with a 30 delta here, and I will go ahead and add this in as a potential trade here. So I'm selling this one. Let me go ahead and adjust this so you can see this strike here below. Okay, so right here, we've got the strike that is about a 30 delta, collecting $1.56, so $156. Now, this is the naked option, right? There's no protection that's put on here. And if we go ahead and we look at this risk profile of what this actually looks like, you will see, sorry, I have some GameStop positions, so let me take those out. You will see that this loss just goes to infinity. Right? If GameStop kind of comes up here to $160 for whatever reason, you're going to be $12,000 in the hole. And that is that unlimited risk here. So we're going to go ahead and we're going to add this expiration date. We want to see what the distribution is for that. Now, this gray thing that I kind of got penciled in here, this is the one standard deviation move. So you can see this blue line here is my profit of $156 up to the strike, that 30 delta strike of $37. And then above $37, we start to lose. So my break even is somewhere around $38.60. The break even is going to be your strike plus the premium that you collected. So let's go ahead and go back here. And so I want to add a protection leg. And so what protection leg I want to add really depends on the risk that you want to take. So let's just say for me, we'll just stick with this five wide thing. So 37 plus 5 is going to take us out to 42. So I'm going to buy the 42 leg. So this is going to create a vertical. So I'm selling the 37 and I'm buying the 42. Now look at this credit. All of a sudden, I've given up a ton of money to this trade because this buying this protection is going to cost me maybe $130 to buy this, but I'm only collecting $160 somewhere in there. So we take a look at this profit and loss, and here is where we start seeing, okay, what is my maximum loss? So maximum gain now is only $31. Maximum loss, $469. This is where that call skew really, really hurts on your protection leg. Is you have to give up a ton for this protection because the price does not fall off fast. So that really, really eats into your profit. So this absolutely does not meet my criteria of my trade. And you could say, okay, well, I want to keep more of this money. Well, in order to keep more of this money, you're going to have to come here and you're going to have to come out on the option chain to say, okay, well, let me go out here to, I don't know, $110 because now you're talking about $37 is going to cost. So let's change our protection to $110. Now we're keeping 127. Cool. I'm getting a whole lot, but check this out. When you go look at your profit and loss here, this becomes pretty crazy, right? Your maximum loss is now $7,173 because the width of your strike is so far. And that's where kind of tailoring this around, you're like, you know what? I don't want to risk that much. I want to keep this tighter. So maybe you put in $40. Right? So you put in $40. Well, now you're only collecting $20 because you're paying even more to tighten in your protection. And so this is where you kind of got to finagle around a lot of your prices to see where it fits. But let's go ahead, and let's look at the same option, but let's play it on the bullish side. Okay, so maybe your thesis is it's going to stay where it is or it's going to get rocket fuel and go up, but let's say you're going to sell the put vertical. So this was all an example of selling the call vertical, but let's go back and say, okay, what if we sell the put vertical, which doesn't have all that skew? So I'll clear this out and we'll come back here and we'll go to the put vertical. So again, we'll look over here at the deltas and we'll start at, the 30 delta. So here, let's go to 27 and let's go ahead and sell the 25. So we're going to collect $130. I'm going to go ahead and, look at this premium here or look at this risk profile. And you can see here's the curve collecting $130, but there's an infinite risk. Basically, the stock can go all the way to zero, but let's leave that there and let's add our protection leg. So look at how quickly these drop out. I go down just $1 and now I'm at about $90 for protection. I go down $5 down to 20, and now I'm paying only, about $20 for this protection leg. So let me add that in. Now I have a credit of $114 for a $5 wide, and all of a sudden now I have a little bit more. Now it doesn't meet my 1/3, but you can see where this really comes in, where my maximum gain is $114, my maximum loss is $386. Now, this is not one that really happens to have enough volatility in it to meet that 1/3, but it's these mechanics that I want to show you. And this is that skew, which is so important when it comes to verticals, because that skew really eats into your profit. And that's really what a lot of people kind of gauge about when they say, okay, what's the protection? Some people like defined widths, so they always look for a $5 wide strike. Other people just say, you know what? Let's see how far out I have to go to where that protection is negligible. So maybe that protection is this 18 strike. And so that's going to make it a little bit wider, but you're going to keep more of your premium. So now we're going to keep $125, and then you've got this maximum loss of $575. But here's the thing. You can take one of these bars and say, well, what's the probability that we're going to be above this or below this $18? And that's what you get up here is this says there's about a 13% chance that you're going to be at or below $18 at the time of expiration. So that is basically the option vertical and where you can really define a lot of the risk. And that's really important because of the amount of buying power and things like that is needed to put on these trades. When you define your risk, your buying power is equal to the width of those strikes. So if you want to go put on a $5 wide option trade, it's only going to cost you $500 in buying power. Whereas that same potential trade will, if it was naked, will take much, much more buying power because your broker is going to want to cover the probability and possibility that underlying is going to have rocket fuel and really push your options way in the money and cost a lot. And so the option vertical is really, really important for those that want that high probability trade of selling volatility, selling time premium, but they don't have the risk appetite for the naked option, or they don't have the account size to deal with the added buying power for that. And the option vertical is something I used incredibly heavy early on in my trading career because it's all I could afford to trade. And it kind of stinks a little bit because you have to give up some of that profit for that protection leg. But what it allows you is it allows you to not have massive losses, and it also allows you to put multiple trades on because of that buying power consumption. And then as you kind of grow your account larger and larger, you don't need as much of that protection from a buying power standpoint. Now, you might still want it for your risk appetite, and that's perfectly fine. And honestly, when I trade certain underlyings that are extremely volatile or extremely memey, I will kind of put on protection legs. Now, I put on protection legs that are more equivalent to naked, so I don't keep them very tight because a lot of times, let's just take GameStop, for example, okay? Let's say we have some underlying that is very, very, very heavy call skew. In order to protect me from an outside loss, maybe I'm okay trading it naked, right? But I want just the chance that in case this thing goes, 500%, 600%, that I have some like uber hurricane insurance protection. I might go out on the option chain to where that call is much, much less. But because there's so much call skew, I got to go way out to find it. And that helps me with that really high thing. And then if it expires in between, okay, I'm out my money on my long side, but I deal with the assignment, or maybe I'll roll or something like that, that short side. Now, you can't roll the whole vertical, which is one of the negatives. But it really just goes into that risk appetite that you have to decide for yourself. And a lot of the brokerage tools will let you see the P&L charts of whatever hypothetical trade you put on. So kind of like I put up there in the Thinkorswim platform, where you can kind of add your strikes, then take a look at the P&L graph. You can look at the probability of where it's going to fall at the time of expiration. You can tweak your strikes to see how does that impact your profit and loss potential. And really, it's all about manipulating those numbers to the point of finding something that you're comfortable trading. Now, that brings us to the end of this week's episode, and it's really about defining risk and talking about how you can start selling options in a manner that where your risks are fully defined and you know your maximum gain and your maximum loss in every single trade. Now, the nice thing about this, in my opinion, is there's no, oh, how much can I lose? What's going on? There's no unknown. There's no uncertainty. And it also lends itself well because there's no management option either. You put on your thesis for your expression and you let it ride. And you don't have to monitor it every day. You don't have to see, oh my gosh, is it going up to the moon? Is it going to zero? What's happening? Because at the end of the day, it doesn't really matter, because your trade is almost like a binary trade, right? You're either going to win or you're going to lose. Now, you can have profit targets that say, hey, I'm going to close this out once my premium decays about 50% or something like that. Those are targets that I have on the profit side, because there's no reason to keep that trade out there once you have captured a good chunk of that premium, right? The stocks can still swing wildly, so you might as well pocket the gains when you have them. So when you get the move and the collapse in volatility and the collapse in time premium, if you get enough of that premium collected, you might as well close it out and move on with life. But if you start getting challenged, you're fine knowing that you were okay entering that trade with that maximum loss. So you shouldn't freak out if you start getting challenged on your strikes, or if your strikes get breached, because you have crafted that trade to your risk tolerance. And that's where I think when you want to get into the option selling, 100% everybody should start with the vertical, because you'll experience how the Greeks move. You will experience how the premium changes over time. You will experience how the premium changes with volatility. And you do all of that without the unlimited risk of a naked option trade or selling a naked call, selling a naked put. Because you have purchased that protection leg. And so the very first options that I traded were 50-cent wide options. It was at the time it was Kohl's. Kohl's had, for whatever reason, 50-cent wide strikes. And so I was basically trading like dollar wide options. Now, not all options have dollar strikes. Some of them do, some of them don't. A lot of times you'll find that $5 is a pretty normal distribution for monthly options. So if you look at monthly options, your strikes are going to be about $5 apart. The weeklies is usually where you start seeing the dollar strikes. And sometimes for really big names, your monthlies are actually going to be in $10 increments, not $5 increments. But all of that stuff is things that you can tweak. They're different knobs you can turn, different things like that. And at the end of the day, it is all statistic based. It is all driven on mathematics. And you can really express your thesis in a manner that doesn't require a lot of attention. It doesn't require stop losses. It doesn't require a lot of the other things that traditional swing trading or price action trading brings with it. The trade-off, of course, is your risk is a little bit lower. Means your profit is a little bit lower because the probability of success is a lot higher. So depending on where you pick that short strike, that is going to determine a lot of your percentage chances of winning. So if you go with a 30 delta strike as your short strike, you're going to have roughly a 70% chance of success. If you move further out to a 20 delta, you're going to have an 80% chance of success. And your premium you're going to collect is going to be less, but that is going to be statistically relevant to where you position. And I can tell you by placing hundreds of thousands of trades, that delta measurement is very, very, very correct in the aggregate form over time. So whatever the deltas are that I end up trading, that really reflects my win rate largely. I would say my win rate is slightly higher than the delta because that delta is often, I enter when the trades are extra volatile, and a lot of times volatility tends to be what's known as overstated. So the number that is there is a higher chance of kind of going against you, means there's more freak out than what actually happens, which is in your favor as the option seller. So while the numbers might say you only have an 80% chance of winning, because that is an overstated number, the actual reality after time passes and volatility goes away, it might end up being like an 85% win rate or something like that. So the numbers that you see in the option chain, if you are dealing in an extended volatility case, will tend to be more conservative, which is good in my opinion when you look at this trading strategy. So hopefully you guys have gleaned a bit of information out of this. I'm going to go ahead and add this one to more of the beginner series that I have going. And if you have any questions, drop them in the comments below, hop in our Discord, let me know what you got going on. And hopefully this helps demystify some of the option selling things. Good luck out there as we kind of wind down the year. We'll see what happens as the year pans out here. We've got an upcoming year reflection from trading from myself, Viper. So stay tuned for that. Good luck out there. Have fun. And remember, think outside the block.